Hello, good evening, everyone. Sorry, we are starting the class rather late, but we'll kick off very soon as we are able to send the YouTube link to those who are unable to join this class. So as soon as the YouTube link is set, so that they can also join, then we'll start. Okay. Um, Mr. Topper, can we?
Hello, sir.
Yes, sir. Can we continue now? I
Yes,
think we
yes,
are
you can
set to go.
continue. Yes,
Okay.
very fine.
Oh, okay. I want to check if I'll be able to share screen. Okay. All right. Good evening, everyone. Once again, sorry, very, very sorry if that we are starting very, very late. Um, Today's class is going to be a continuation to our last week discussion on the preparation of financial statements for government institutions. I believe those of us that were that joined the class last week, you still remember that we talked about. Okay. May I confirm if my audio is clear enough before we continue?
Yes, sir, it's clear. It's very clear.
Yeah, very clear.
It's
Okay, good.
clear.
Okay, good. So, which
Very,
means,
very clear.
okay. So, anybody that is not hearing me should check his or her network. Yeah. All right. So, you have not even started. Somebody is raising hand. Okay, is it very important? If it's very important, please let's quickly hear you. Elizabeth.
Those people are just distraction.
Okay.
The
Sorry,
hand
it
has
was a
been raised.
mistake.
Okay. All right. So we'll, we'll be starting from where we left off last week. And last week, if you remember, we discussed about preparation of financial statements under the cash basis. All right. And I believe we still remember the components that we mentioned of the financial statements under cash basis last week. I don't know. Okay, maybe if somebody can quickly mention the like 4 important ones, 4 or 5 important ones. We have 100 people here.
Okay, good evening, sir.
Somebody's good evening.
We have components of financial statement. We have the cash flow statement, the statement of
Okay,
assets and liability, statement
yes.
of consolidated revenue funds, statement of
Okay, good.
capital development funds, notes to the
Okay,
account, performance reports,
all right,
statistical
good.
reports, and accounting policies.
Okay, good. All right. Thank you. I wouldn't want us to, I would have called some other people to also explain some of this, but I don't want to take us to take much time. I will use another class to do that another time when we have more time. Okay, so today we'll be delving into the preparation of financial statement of government under the accrual basis. Meanwhile, we have not prepared the cash flow statements under the cash basis that we did last week. I remember the question we solved last week. We were able to prepare other three, the other three fundamental ones, which are the statement of assets and liability, consolidated revenue fund, and then the um, uh, statement of capital development fund. All right. So now we'll, we'll leave the cash flow statement until when we now get to this accrual basis. That was what I said last week. So now under the accrual basis, we'll look at what are the components of the financial statement of government under accrual basis. Okay, so remember we said accrual basis. What accrual basis means is that in recognizing and measuring transactions, the entity will recognize their revenue and expenditures when they are earned or when they are incurred, and not necessarily when payment is involved. That is what accrual basis is. And when we discussed the basis of accounting in our earlier classes, we talked about the fact that accrual basis is much more um, uh, advantageous to institutions, to entities for their financial statements than the cash basis, because the accrual basis shows a more realistic view of the situation of the entity. Okay. Now we'll now look at under accrual basis, what are the provisions of the International Public Sector Accounting Standard, IPSAS, for the preparation of financial statements. Under IPSAS, there is a particular IPSAS known as IPSAS 1, which talk about the presentation of financial statements of government institutions, of government agencies, and even governments as a state. And this is where the details of the components of financial statements of government under accrual basis, using accrual basis, are mentioned. And these are the statement of financial position, the statement of financial performance, statement of changes in equity, the cash flow statement, of course, and then statement of accounting policies, and then another IPSAS, which is statement of comparison of budget and actual amount. This one is also treated in a separate standard on its own. and it's expected to be part of the component of financial statements of government. That is, I think that's IPSAS 24. So let's look at these statements one after the other and see what what they look like. Like I said earlier last week, that in approaching this topic on preparation of financial statements, what you need to do is to understand the 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 nature, the nature of each of these accounts that are expected to be prepared. So once you understand their nature, you don't have to cram so much. What you need to do is, once you know their nature, you know what their content is supposed to be, and then that content is what you search for in the question. So even if you are giving questions that's as long as anything, as soon as you know what you want to put inside your statement that you want to prepare, that is what exactly you will find in all the stories that they put there. So that's why we'll first look at these questions, this statement, and talk about how what is their nature, what they look like. Okay, so let's look at first the statement of financial position. It is the statement of financial position that we have known before. It's not changing. It's just that this one is prepared for government. And what we know as the nature of the statement of financial position is that it contains assets and liabilities. That's all. And then equity. So inside the statement of financial position, you see all the assets of that entity, all the liabilities of the entity, and then their equity position as well. Now, the only difference in preparing this statement of financial position, which is the government's own, compared to the way you have known that you prepare it in FR, is in the presentation. In the order with which you present them. So the most common way in the public sector preparation is that, in the private sector preparation that the way you prepare it in FR is that you prepare you get your total assets, and then you get your total equity and liability. All right. But in this case, what you do is that you get a net asset. That is, after you get your total assets, you deduct your liabilities from it, you get net assets, and then you compare it with equity, which is the funds of the government. So that's basically what's really differentiates it. But the content are basically just the same thing. So the assets entity and then the liabilities. Now the task that you have in this situation is now for you to identify the assets in every information that we are giving. For you to now identify assets and identify liability. And I believe everybody at this stage of our professional journey will be able to identify what are assets and what are liability in a group of information that we're given, whether it's trial balance, whether it's additional information or whatever. Okay, so the next one is the statement of financial performance. As you can see, it's still the same name that we call it in the private sector accounts. Statement of financial performance. And what this one shows is the operational performance of the entity. That is the result of the operational performance of the entity for a particular year, for a particular period that is ending. So it will involve their revenue and their expenditures, nothing more. All their revenues for that year, in quotes, for that year, all their revenues for that year, all their expenditures for that year. So which means in a situation, if you are giving information and then it involves revenues or expenditures that does not relate to that particular year, so your matching concept, your matching concept knowledge have to work. So which means you should know that revenues or expenditure that does not relate to the particular year you are preparing for will not enter that particular statement you are preparing. So that's the nature of that statement of financial performance. It is for revenues and expenditure. And then the major thing that differentiates it from the private sector one is that in the private sector, when you prepare it, what you finally get at the end of the day is what? Your profits or net profits or profit after tax or any way you want to call it. Well, in this case, what you will get, because it's the public sector and they are not entities that are meant to make profit, what you get is surplus. All right. Or sometimes it's you call it consolidated revenue fund balance. That is, by the time you add your surplus to the balance you have in your consolidated revenue fund, you have a consolidated revenue fund balance. But what you arrive at eventually is surplus. By the time you deduct your expenditures from your revenue, you get surplus instead of getting profits from as is in the case in the private sector. So that is the statement of financial performance, revenues and expenditures. Once you know that, and you know that the only thing I need inside this statement is revenue and expenditure, you don't have problem. So the only thing is that you must know that the revenue and expenditure you are putting in there are those that relate to that period you are preparing for. Okay. Next one, statement of changes in equity. The changes in equity is still the same thing with the one you know. That is it looks at the equity of the entity, that is their fund, their capital, whatever name it is called, at the beginning of the period. It looks at it at the end of the period, and then look at what changes have happened, what additions or subtractions have happened to their equity position during that year. So I've made the equity position at the end of the year different from what it was at the beginning of the year. That is what that statement will only show for us. And then the cash flow statement. The cash flow statement that we said earlier, even if you are preparing under accrual basis, you still prepare your cash flow statement using the cash basis knowledge. So because the cash flow statement is just the statement that will show the cash movement of the entity for that period. Okay, so then others, the statement of accounting policies, statement of the notes to the accounts as well. Then the statement of comparison of budgets with actual amount is one that will show the the accounts for the year, that is the results of the year in comparison with what was budgeted. So if you are preparing that statement, you show your column where you are, there's a column where you are showing your financial results for the year, that is your revenue, expenditures and all. And then another column by the side will be showing, okay, the revenue that you are reporting of 1 billion, how much was budgeted at the beginning of the year to be there. Okay, we budgeted 1.5 billion, actual 1 billion. Expenditure, we budgeted 800 million, actual was 900 million. So it will just show a comparison of what you have as your result, as your financial statement, against what was budgeted for those particular items. Okay, so that is basically the rundown of what those statements really look like. So that's talking about their nature. So the items, okay, that like we mentioned earlier, those items that are in the statement of financial position, the assets and the liabilities, with the non-current asset and the current asset, then the tangible and the non-tangible assets, all their financial assets, investments, inventories, receivables, cash as well. Then their liabilities include their payables, provisions, and so on. Have non-controlling interest as well. All of these will be in their statement of financial position, and then their financial performance as well. All these things that I mentioned, their operational revenue, expenses, interest, which is finance cost, then their surplus as well. Okay. So those are basically the nature of all these financial statements that we have. Okay. So we'll take one question that is not really long because of time, so that we can do a little practice, at least for a start on that one. Maybe some other classes will look at some other more complicated questions and see we can lay our hands on them and also discuss them together. So, is there any question before we move forward?
I think we can proceed.
Okay, all right. Okay, let's look at a question. The question on May 2023. May 2023, question 1. Okay, let me share my own screen. May 2023, question 1. If you have your Pathfinder with you, you can open to that. Okay. I believe everybody can see my screen, right? Okay. So, in this question, we have we are given a trial balance that belongs to Govt state government for the year ended 31 December 2022. And we have all the items listed here. Also, we have a few additional informations at the bottom of that trial balance. Then we'll be looking at those additional informations. Okay, the information given, I think about 4 of them. The first one is that there's a loan interest outstanding at the end of the year, which was 12.5 billion. Okay. There's also depreciation, information on depreciation on tangible assets. Building is 5%. There's also depreciation. Information 20%. Equipment and furniture is 15%. The third information here is that a building costs 12.5 billion with accumulated depreciation of 5 billion was sold for 11.25 billion. This transaction has not been adjusted in the account. Okay, so if you look at this information very well, this information is trying to test our knowledge of the standard on how to treat non-current assets that are disposed. That is IAS 16 or IPSAS 17. Whichever one, the treatment is still the same. So it's trying to test our knowledge of the preparation of the treatment of disposal of non-current assets. So that's what we'll do here. Then the last one says there's an interest amounting to 10 billion. Okay. So we are required to prepare financial statement of financial performance for the state for the year ended 31 December 2022. And also we are required to prepare a statement of financial position as at the same date. Okay. So let's get right into it. Maybe as fast as possible. I think it was the name of the state is Govt State. And what we are asked to prepare is the statement of financial performance. Okay. So this is okay. Let's say the figures we are giving are in billions here. Okay, so we abbreviate to a million. A million here. Okay, so as we know from our preparation of financial statement, we always start with revenue. So statement of financial performance, and we said the nature is to contain just the revenues and expenditures of that entity. So we want to see our revenues and expenditures. So we'll start with revenues. And okay, revenue. So let's go into our question and search for items of revenue that we can see from our trial balance as well as from our additional information. Okay, so you can see that if you check the credit side of the trial balance, I can be able to identify quickly our revenue items. You can see Federation account allocation, there's VAT allocation, there's grants from federal government, there's internally generated revenue, there's also grants from donor agencies. Those are all revenue items. If you look further down, you also see an item here that is called miscellaneous expenditure and revenue. So we know that the one on the debit side will be our expenditure, and then the one on the credit side will be our revenue. So, and then which other one? Okay, so let's pick all these items and then fill them in. Federation account allocation, and that is 287,500. 287,500. Okay. And then let's look at the next one, VAT allocation. Which is VAT allocation, which is 87,500. It's 7,500. And then next item there, grants from federal government, which is 33,750. And then internally generated revenue, internally generated fund, which is 97,500. Also, a grant from donor agency. That is 25,000, I think. Okay, 25,000. Okay. Now, we also said there is miscellaneous income, which is 61,250. Miscellaneous income, 61,250. Okay. Now, let's go into our additional information. There are other items of revenue that we also need to recognize. All right. So the fourth item here is a loan interest outstanding. This is not a revenue. This is outstanding expenditure that they have not settled. Okay. The next one is depreciation. Okay, that's also an expenditure. The next one is this one is talking about a building that was disposed. Okay, so we need to check this building.
Sir.
Okay. Yes.
Sir,
please.
there's consolidated leave allowance in the trial balance. Is that not an income?
Consolidated what?
Consolidated revenue fund in the trial
Okay.
balance.
Now, okay. Now, this consolidated revenue fund is not a revenue item. Is a balance, a fund balance. All right. Is a balance in their CRF account. That is what the CRF that item is. It's not an item of revenue. The fund balance is that like an equity balance, so to say. So it's like maybe it's like your capital in a business. So it's their fund balance. That is the fund they have been using. That's the fund they use to settle all their expenditures and all of them. So that is their, we talked about consolidated revenue fund last week as well, where we said it is the fund where all the revenue that they receive goes into. So that's is the balance in that account that we have there, not a revenue item itself. So all these revenue items that we have mentioned are already inside that balance that you see there.
Okay, sir.
Okay. All right. So you need to look at this particular transaction, that is this item number 3 of the additional information, to see if it results into
I'm
a
sorry, sir.
loss
I have a question.
or a gain on disposal. Okay.
Okay, so please, I'm just a little confused. This format looks a whole lot different compared to the one we use for FR, because of I was thinking that miscellaneous income would be other incomes, but we just added it to the revenue.
Okay.
Yeah, I don't understand. I wasn't in the first class. Perhaps there was a format for it, but I didn't see that format.
Okay. All right. Now the miscellaneous income is still part of their operational income. It's still part of what we recognize as our operational revenue. All right. So, except if the miscellaneous income is being further explained, and then you are able to say that okay, it is not part of operational revenue. But since the miscellaneous income, it is generally other the incomes they get from operational activities, like maybe it involves incomes from taxes and maybe some other things. That is why they just name it miscellaneous income. All right. So
Okay, sir. Thank you,
the
sir.
format will be the format will usually be uh, technically different from the one you have in FR, because of the fact that in FR you have the trading part before you now begin to have the your expenses, where you have to generate, compute your gross profit first for do your other expenses and all of that. So the format will generally be different a little, technically. So the point here is that the revenues should be identified, and then the expenditures as well should be identified and deducted from it in order for you to get the surplus.
Okay, sir.
Okay. Now, moving forward, we said on this additional information, we want to check if there is a surplus. If there is a gain or there is a loss on disposal. Now, according to the provisions of the IPSAS 17 or IAS 16, talking about non-current assets, when there is a disposal of non-current assets, there is usually supposed to be whether a gain on disposal or a loss on disposal. So that is what we'll test on this particular item as well. Okay, so let's go back to our solution page. Get our workings. Okay, maybe I should do the workings on a separate page. Okay. Okay. So disposal of non-current assets. Or let's say disposal of building. Now, calculate a gain or a loss on disposal of non-current assets. The way it is done is that you have to deduct the proceed from the sale of that non-current asset. From that proceed, you deduct your carrying amount of that asset. What we are saying is that the value at which you are valuing that asset in your own books compared to the amount you are able to sell it is what will determine whether you have a gain or a loss from that disposal of that asset. So how do we go about that? So we say the cost of the asset. So in order to get the carrying amount of the asset, the cost of the asset is they are told that the asset that was disposed costs 12.5 billion. It costs 12.5 billion. Okay, so the cost of that building is 12,500. And then the accumulated depreciation on that building, according to the question, also said the accumulated depreciation of 5 billion. Okay, if you see that, so that will give us So that would mean that the carrying amount on that asset will be how much? That's 12.5 billion minus 5 billion. So this is the carrying amount on that asset. And then we are told that the asset was now sold for how much? 11.25 billion. Okay. So the sales proceed is 11 to 50 is in million naira. So which means if you compare the amount at which you are carrying the assets in our books to the amount we are able to sell it. So if to us in our books, the assets, but the value of that asset of that building is 7.5 billion, and then we are able to sell it for 11.25 billion. So have you made a gain or a loss? So definitely a gain. All right. So that means we have a gain on disposal of how much? 11.25 billion minus 7.5 billion, which is our own value. So a gain on disposal of 3.75 billion. That's 3,750,000,000. So this value is a gain on our disposal of the building. Okay. Now let's go back to the question. But this being a gain on disposal, we're going to recognize it as part of other income, not operational income. So let's look at other information we have here. If you have any other gain, any other revenue items. From additional information number 4, we have interest on receivable. Interest on receivable, yes, amounting to 10 billion. That's also revenue. Okay. But this is also a revenue that we can recognize as other income. So I believe with that we can now go to our let's take this as operational revenue. Operational revenues. And this here, we have a total of this. And then we can have our operational expenses, expenditures as well. Expenditures. So if you go to the question again to check for the expenditure items that we have, easily we can check through our debit side of the trial balance and find out if we have items that look like expenditures. From the beginning, we are building investments. These are all assets. We have accumulated depreciation. We have cost of motor vehicle. And then here, we have personnel emoluments here. So we have maintenance expenses. We have CRF charges. We also have overhead expenses and then miscellaneous expenditures as well. So all these are expenditure items that will take one after the other. So personnel emoluments first, and that is here 125,000. Also, we have maintenance of premises, which is 5 billion. We also have consolidated revenue fund charges, that is expenditures that were taken from the consolidated revenue fund, and that is 32,500,000,000. We also have overhead expenses, which is 25 billion. And then I think lastly here we have miscellaneous expenditure, which is 37,500,000,000. 37,500,000. Okay. Now let's look at our additional information if there are other expenditure items as well from what we are giving there. Now the first one is that there's a loan interest outstanding at the end of the year. So this is also this is an expenditure, but it's not an operational item. So we can treat this as finance cost. It's a finance cost. So we treat it separately as finance cost after we must have gotten our operational surplus. Then we have depreciation. So we have to calculate our depreciation based on these rates that we are given. So we are told that building depreciation is 5%, on motor vehicles is 20%, and then on equipment and furniture it is 15%. Okay, so let's go back to our question. Here's my question. Okay, so let's calculate the depreciation on building. From the question, we are told that the cost of land and building is 387,500. But here we are told that the building, the cost of land from that 387,500 is 250 billion. All right, so we have to subtract the cost of land, because as we all know that land does not depreciate. So the depreciation is going to be calculated only on the building part. So the cost of land and building is 387,500. Okay, so let's go back to our working page. Depreciation. Land and building first. So the cost is
Hello, sir.
let's say land and building 387,500. Okay.
Sir, you forget to add the 3.75 that we realized gain on disposal
No, I
to
didn't forget.
under the revenue.
No, it's not forgotten. Are you with me? It's not forgotten. It's going to be added as
Okay,
other
okay.
income. Yes.
Okay, sir.
Okay. So this is cost of land from the land and building. So that means we're going to have 137,500 as the cost of building. Okay. So it is on this cost of building that we are expected to calculate our depreciation. Meanwhile, we are already told that during the year they disposed building that costs 12.5 billion. All right. So we need to deduct that as well, because a building that is already disposed, we cannot be charging depreciation on it any longer. So in that case, disposal will come in, and that is 12.5 billion. Okay, so which means we are subtracting that as well from the cost of building, and then that will give us 125 billion as the depreciable value. Okay, it is on this that we will now calculate our 5%. So 5% depreciation. The depreciation will now be 5%. That's 5%. 0.05. So that will give us 6.250 billion. Okay, so and then depreciation for which other one? Motor vehicles is 20%. I think that one is straightforward. There's no issue on that one. 20% of motor vehicle. That's 20%. So the cost of motor vehicle is cost of motor vehicle is how much? Where is it? Okay, 145 billion. And then the depreciation at 20%, 0.2. Yes, that will be 29 billion. And then the third asset is furniture, the equipment and furniture. So which the cost, and then depreciation at 15%. So the cost of furniture and equipment 67,500. That's 67,500. And that's 0.15. You have 10 billion 125. Okay. Raising hand. You know that time is gone. Okay. So With this, we can have our total depreciation for the three assets together. Total depreciation. So that will be the depreciation on land and building plus the one on motor vehicle, and then plus the one on equipment and furnitures. So which will give us 45,375, which we can bring to our solution as one of the operational expenses. So this is depreciation. Okay. So after that, we can have our total operational expenses. Which will be this. Okay. So we can subtract this from our operational income, which will give us our net operational surplus. So we surplus from the net operational income, the total operational income, and then subtract the total operational expenses. We have our net operational income, operational revenue. Let's say revenue. Okay. So then we can now add other income, which is the gain we got from the disposal of building that we calculated at 3,750. So have a 3,750, and this will be our total revenue. Then we can bring our finance costs into it, which is the interest in the additional information. We are told that there is an interest outstanding that they have not paid, which means they have incurred interest on loan, which is 12.5 billion. So we can bring that interest on loan, or we call it finance costs. And that is 12,500, if I'm correct. So if you subtract that interest from the 325, what we have will be our net surplus. Okay. So then we can now bring in our balance, the balance on our CRF before. That is the one somebody was calling our attention to earlier, which is the CRF balance. So we can bring that in and add it to our surplus. Okay, let's name this one our surplus for the year. So you can see that this is the result of comparing our revenues. Sorry, there's still a revenue item that we have not treated, which was the one we said we also treat as other income, which is the interest they received. We treated the interest they paid. So this is the interest they receive that we are supposed to treat as well, 10 billion. So we'll bring that in also as part of the other income. Interest and 10 billion. So other income, in order to identify this, gain on disposal of building. Okay. I hope the formula has worked for all these things. Okay. Okay, good. Okay, so now we can now bring our CRF balance from that we have in the trial balance in order for us to get the total CRF balance that we'll carry as our equity value in our statement of financial position. And this here is 81,250. So this is consolidated revenue fund. Brought down. We carry it down. Carry it down. This 81,250. And then we have consolidated revenue fund carry forward. It will now be the sum of the two, and that will give us 4,625,000. Okay. So this is the end of the statement of financial performance. So that is, we have been able to identify all the revenues, we subtracted the expenditures, and then we got our surplus for the year, which we now add to the balance that we have already before. Okay, so I think I want to take a couple of hands that were raised. A couple of hands were raised. Okay, so which means maybe you can move forward. Their questions have been sorted. Yeah, so we go to the second part of that question very quickly. I don't think that should take us more time as the financial performance. We are asked to prepare the statement of financial position. And so we know that the statement of financial position is expected to show assets and liabilities. So we are going back to the trial balance to pick those items that we ignored before, which are the assets and liabilities. because they are not relevant to the financial performance. So we want to treat them now. Okay. Let's go back to our question. Okay. Now, as a president of financial position, as at 1st December 2022. Let's put that under here. So, as a single verified position that we have said before, start with our assets, and of course, it starts with non-current assets. Okay, so let's look at the non-current assets that we have, which are the building, land and building, the motor vehicle, and then the equipment and furnitures from the question. So, what we need for statement of financial position is to know their costs, subtract their accumulated depreciation, and then we have their carrying amount, just the way we always have it. So now this one is going to take us a little bit of some tricky calculations, especially for the land and buildings, which involves disposal of certain parts of that asset. So let's go to our workings page. Now, in our workings page, we want to calculate what is going to be the cost of land, what is the cost of land and building, its accumulated depreciation, and then the carrying amount that we're going to have at the end of the year. So, non-current assets. Let's take it one by one. For land, we have land. Sorry, land and building. Land and building. So the costs of the land and building, according to what we are giving in the question, is 387,500 for land and building. Okay, so if the cost is 387,500, and we are told that during the year there was a disposal of land of a particular building that cost them how much? 12.5 billion. The building costing 12.5 billion was sold. So we have to remove this building that has been sold, because now what we want to do is to account for the land and buildings that we have as at the end of the year. And as at the end of the year, like we all know, a particular building has been disposed. So that building that is disposed is not going to form part of our statement of financial position any longer. So we'll deduct it, disposal. These are all what you later learn in IAS 16 or IPSAS 17, whichever way please you learn it first. Okay, so disposal is 12,500. Let's put it in negative minus 12,500. Okay, so even after we have disposed that, what we have left as the cost of land and building will now be 375 billion. Okay, now you can send this into our solution if you want to make it, if you want to do it on the face of our solution here, or maybe let's do everything in the workings and just bring the total values. Now, this is the cost of our land and buildings. And then we want to deduct the depreciation from it so that we can get our carrying amount. So for depreciation, you have accumulated depreciation. Accumulated depreciation that we have is how much from the for land and buildings. Accumulated depreciation for land and building 40,000. This is it here. 40,000. Okay, that's 40 billion. So 40. Now, well, out of this accumulated depreciation of 40 billion, it includes the accumulated depreciation on that particular building that has been disposed as well. I hope we get that. That 40,000 includes the accumulated depreciation that has been charged on that particular building that we have disposed. And so because we have disposed the building, we cannot continue to carry the accumulated depreciation of a building that we no longer hold as part in our account. So which means we are going to expunge the accumulated depreciation on that building that was disposed as well. So if you check our question back, you see that we are told that the building costs 12.5 billion and accumulated depreciation on it is 5 billion. Okay, so we need to remove that 5 billion from the value of the accumulated depreciation that we have been carrying. So accumulated depreciation on disposed assets, and that is what 5 billion minus 5 billion. Okay. So the next thing we need to do is to now charge the depreciation for that particular year. You know that this accumulated depreciation is 40,000 or 40,000 is the depreciation from the previous years. Now the current year depreciation that we have calculated will also be added to the accumulated depreciation. So let's look at the depreciation for the year. So for the depreciation for the year that we charged on land and building was how much? We go up, we can see our workings, depreciation at 5%, 6,250. So we can bring down that there, 6,250. So now total accumulated depreciation is now what? So we have this together, we have total accumulated depreciation of 41 billion 250. All right, so which means our net book value or carrying amount, as we want to call it, for land and building, carrying amount will now be equal to the costs of land and building minus the accumulated depreciation, and this will now give us 333,750. So this we can now take to our solution as the cost, the value of land and building. So non-current assets, we have land and building. Land and buildings. 333,750. Okay. For the other ones, I think they will be more straightforward, since please, who is not meeting? Who is this person? Olufemi, please mute. Thank you. Olufemi, please mute your mic. Oh. Thank you. So the other two assets will be quite simple, since they don't have the complication of disposal and all of that. So let's look at them. Okay, this land and building. Okay, let's even use this place. Land and buildings. Then the other one is a motor vehicle. So the cost of motor vehicle from the question is how much? Cost of motor vehicle is 145,000 here. 145,000. So can bring that here, 145,000. And then there was no disposal for motor vehicle, as we all know. So which means this will still be the same. Okay. Now, accumulated depreciation on motor vehicles is 30,000. So let's bring in our 30,000 accumulated depreciation. And then there was no disposal for motor vehicle, so there will be no accumulated depreciation on motor vehicle to be removed. And then depreciation for the year that we calculated for motor vehicle is how much? Okay, yes, 29,000. So depreciation for the year 29,000. So total accumulated depreciation on motor vehicle will now be 59,000. Okay, so which means our carrying amount for motor vehicle will now be the cost minus the total accumulated depreciation, which will now be 86 billion for motor vehicle. So we can come to our solution page, motor vehicle. $86,000. Okay. Now, the last one is the equipment. Equipment and furniture. Equipment and furniture for the cost. For the cost is going to be equipment and furniture. Okay, we have 67,500 as the cost of equipment and furniture. 67,500. There was no disposal for that as well. So the total here will be the same.
100. 14. 14. 100 minus 14.
Can
Stop
Oluwafemi Amao mute yourself? You are
Stop before you
disturbing the
talk.
class.
It's
Oluwafemi
disturbing
Amao, mute yourself, please. You are disturbing the class. Thank you.
Thank you. Oh. Okay, So we now have the next item to be treated. Where were we? Okay, now we want to look at the accumulated depreciation on motor vehicle, on equipment and furniture. So accumulated depreciation on equipment and furniture, 21,250. Okay, so let's bring that 21,250. And then, of course, there was no disposal on that one as well. So this will be new. And then depreciation for the year that we calculated for equipment and furniture is what? 10,125. So if you bring that 10,125, so total accumulated depreciation on equipment and furniture will be 31,375. And so automatically the carrying amount, which is the subtraction of the accumulated depreciation from the cost, will now give us 36,125. So we can take that also as well to our solution. Equipment and furniture, 36,125. So with this, we have the total of the tangible non-current assets. Okay. Now, we also have, I think I saw something on investment. Yes, they have long-term investment. So this is a non-current asset as well, but it's a non-tangible non-current asset. So you can bring that next, long-term investments. Long-term investments, that's how much? 187,500. 187,500. Okay. So after we have that, we can now have the total of our non-current assets. Total non-current assets. Okay, so we can now bring our current assets next. Current assets. Okay, let's go to the question and check for our current assets. So if you look can quickly scan through the debit side of our trial balance and see the assets that we have here and see which one is current in nature. These ones are non-current assets that we have treated. This personnel emolument, that's and expenses, maintenance, all these were expenses that we have treated. Then here we have current assets and liabilities. So if you have something like this, you know that the one on the debit side is the assets, while the one on the credit side is the liabilities. So these are current assets. 38,750,000,000. Now, so what this one means is that they have consolidated all the current asset items. Maybe it is cash, maybe it is receivables, maybe it is prepayment, maybe it is inventories. They've added everything together and put it inside this one line item. Good. So we can go to our solution and just use this. But meanwhile, there are some adjustments that we have made that will now make us to be able to use that one straight away. So which means we need to adjust that figure. Okay, we need to adjust that figure. Okay, so let's go to our workings page again. Current assets. So as per account, we are given a current asset of 38,750,000,000. It's 38,750,000,000. But we know that we made adjustments to a few things that relates to current assets. All right. One of them is that they have told us in the question. Let's go to the question. They told us in the question that there is a receivable on interest. So this is a receivable, which of course is a current asset item. So this one we need to be added to that current asset to form part of our current assets. Okay, so receivable, interest receivable, and that is 10,000 billion. Okay, now another thing is that we are told here in additional information number 3 that a building that cost 12.5 billion was sold for, let's look at this, sold for 11.25 billion. Okay, now after that, we told us this transaction has not been adjusted in the accounts. So it means that this transaction, as far as our records is concerned, this transaction did not happen. So they have not recorded this transaction. What it means is that 11.25 billion that they received from selling that building was not entered into the cash book of the entity. And what it means is that the 11.5 billion is not part of the cash that have been calculated to form
Can anybody hear anything?
11 to 50. What did you say? You said you're not hearing anything?
I can hear you
Yes,
now.
yes, your network was
Yeah,
lost for
yeah,
like 3 seconds.
Okay, sorry about that. Okay. Okay, maybe I should. Okay, let me quickly repeat what I said there. The 11.25 billion that we received from the disposal of building. What this statement that we highlighted here is saying is that that amount was not recorded in the accounts. So what it means is that 11.25 billion was not added to the cash balance or bank balance that formed that 38.750 billion of current assets. So what we need to do is to just go and add that cash amount now that we want to record the proper thing. So we had it to the current assets that we were given earlier in the account. So with that, those two adjustments, you can now say our current asset balance is now 60 billion. Okay, so this is as at the year end now, 60 billion. Okay, so let's go back to the solution and say current assets 60 billion. Now, after we have done this, we can now add this current asset to the non-current assets and have our total assets. So our total assets gives us 703 billion 375 total assets. Okay. Now, after we have gotten this, the next thing is to bring in our liabilities. So we'll deduct our liabilities from the total assets, and then we'll get net assets. Okay, so let's bring our liabilities. Liabilities. Okay, liabilities, just like assets, also have long-term liabilities and current liabilities. So I'm saying current liabilities and non-current liabilities. So we'll start with the long-term liabilities. Long-term liabilities. So from the question, let's look at the question. We have from the liability side, we have long-term investment. Okay, we have these are accumulated depreciation, these are income that we have treated, and then miscellaneous expense income. Then this is 250 billion loan notes. So these are non-current liabilities. Okay, so loan notes. So that is the states have loans that they are servicing, and that is 250 billion. Let's put it here. Okay. Now, if you check if there's I don't think there's any other non-current liability that we have. So that is the current liability, non-current liability that we have. Then we can now bring in our current liabilities. Okay, so current liability as well, if you check very well, you see that there's no other current liability in the trial balance except this one. So which means they have consolidated all their current liability items. Maybe it is payables, maybe it is whichever ones, accrued expenses or whatever. Or short-term debts. They have consolidated everything into this 36 billion 250. So let's take it as current liabilities. Okay. Liabilities. So, but these current liabilities may need to be adjusted as well, just like we have with our current assets. If you look at the current liabilities, if you look at our additional information, we discover that we're giving information about an expenses that is outstanding. That is the first additional information. We're told that, okay, so the first, according to the account, as per account first, which is 36,250, let's take that one. As per account, 36,250. So when then we're told that there's an outstanding interest that they have not paid, which is additional information number 1. Here says there's a loan interest outstanding at the end of the year, and that is 12.5 billion. So outstanding or accrued interest, 500. Okay, with these two, we can have our total current liabilities. So It's at year end. So can take this to our solution 48,750 as the value of current liability. 48,750. All right. So we can now have our total liabilities here. Our total liabilities, which is 298,750. Total liabilities 98,750, which can now be deducted from our total assets in order to get our net assets. So this is our net assets. Net assets. Right? Okay. So these are net assets. Once we get our net asset, the next thing is to now get our equity or funds, as we want to call it. So, and that will be the sole item that we have here. So we can say this is equity. Or you can say, if you want to say equity, you can say financed by, okay, so the CRF balance. And the CRF balance that we have, if you go and check our solution, okay, if you check our solution from the statement of financial performance that we prepared earlier, our CRF balance is 404,625. So, which is same thing that we have here, 404,625. So that'll give us our statement of financial position. Okay. So that's basically the simple step-by-step approach to how we can arrive at preparing our statement of financial performance and statement of financial position. So the only thing, the big task that you have there is to just make sure that you know the nature of each of the accounts you want to prepare. You know what are the contents that should go into the accounts that you want to prepare, so that you will not be posting items of liabilities inside statement of financial performance and calling it expenses, and you will not be posting items of revenue inside statement of financial position and calling it assets. All right. Okay. So let's take a few hands that were up so that for questions very quickly, and then we wrap it up. And then I think I would use that to also check YouTube if there's any important question there. Okay, Mr. Wolafe, can quickly ask a question.
Thank you, sir. Good evening, sir. Thank you for the selfless lecture. I really appreciate your effort. Please, my question is from number one. Number one is between, in the cash basis, we have performance reports, part of the component of the cash basis of the report that we're going to prepare. And in the Accrual, we are having the statement of financial performance. So is there any difference between the two? That is number one. Then the number two is under the CRF. Is it because of we are having it in the credit side that the CRF balance carry forward, recognizing it as part of it instead of taking it as part of the revenue? Then number three is the under the schedule for the, instead of preparing it, I think in the exam, if there's no time, instead of using the asset schedule as a working note, can't I use it directly as part of my current, under my non-current assets, instead of using it as a working note? That instead of me using it, I should just take it directly to the non-current asset, those asset schedule that will prepare. Those are my questions. Thank you. Hello, sir. Can you hear me?
Okay. Now, I think I was able to get your questions. Okay, the first question you asked about, I've even forgotten the first question.
The performance report.
Okay, performance report and
in
statement
cash
of financial
basis
performance.
in the Accrual.
Okay, okay. Yeah, they are not actually the same. The performance reports that we prepare in the cash basis is different from the statement of financial performance. Now, the statement of financial performance, you know, is as a standard
rules.
Standard way of rules or way of preparing it according to IPSAS or according to IAS, whichever one you are using, depending on your entity. But the performance reports in the cash basis statement is talking about a report of evaluation of their performance. So this one does not specify a particular format or a particular rules that they must use to prepare it. It's just their own way of evaluating their performance. They can do it by way of looking at comparing their revenues from previous year with current year. They can do it by way of comparing their surplus from previous year with current year. They can do it by way of looking at their cost reduction.
Okay.
From previous year and second year. So that's their performance report, depending on the parameters they want to use to measure their own performance.
Okay.
So secondly, the CRF balance, why we didn't recognize it as revenue? It's not because it's on the credit side. You know that all the revenues that we recognize as well, they also came from the credit side.
Yes.
All right. But the thing is that you have to identify the nature of these items. Now, the CRF balance, that CRF balance is like I said earlier, is like capital of that entity. It's like their capital. So it's not a revenue item. Okay? It is the fund of that entity.
Okay.
Yeah. And then the last one,
asset schedule.
Yes, asset
schedule as a working note. Taking it direct to the Yes.
Fine. If you do it that way, your mark may still be awarded. But the reason why I think it is better for you to do it in your workings is because in the marking guide, sometimes when you are solving past questions, try and always, after you have solved the past question, you are quoting it, try and check the marking guide in the Pathfinder and see how they have awarded marks to some of the things that you have done. From there, you'll be able to identify items that you know that usually carry mark when they appear in question. When the question requires you to do them, they usually give reasonable mark to it. In this question, I'm very sure that the marks that will be awarded to that non-current asset part will be much. And if you prepare it in your workings as a schedule, That's when you'll be able to get all the marks very well. Okay, it's just like you are solving you want to solve a question in taxation, and then they give you capital allowance. They give you a question that involves capital allowance. You should know that capital allowance question, if you don't prepare that capital allowance table, you will not get that full marks. So that's just the way it is.
Okay. Then the no note, sir. No
Yes.
note. I discovered that when you are doing the working, you put it under the non-current liability. So
Yes.
the one in the additional information,
Mm.
I was expecting that one too should be non-current because it has exceeded 1 year. Because though the question was silent on when the no note took place, but I was thinking that since the first one was the balance was taken to the non-current liability, definitely the one in the additional information to also should be taken to the non-current liability.
No, you know that in loan, in treating loans, the loan itself, that is the capital sum, the principal sum,
Yes.
is a non-current item because you are not expected to pay back within 1 year.
Yes.
But you see, the interest on that loan is a current item. If you take a loan of 10 million from a bank and you're expected to pay in 5 years, the interest on it is not expected to be paid after that 5 years. You're expected to pay the interest annually.
Yes.
So the interest is not is a current item, it's a current liability that you have to pay.
But sir, you know that if we take a loan of 5 years, so we are going to accrue we are going to accrue for the interest for that 5 years, in which the one for the current year will only be charged to the current liability, while the one exceeding the current year will be taken to the current liability. I mean, non-current liability.
No. You see, if you are treating a loan, the interest on that loan, if it is paid in that year, it is no more a current liability. It's no more a liability, in fact. Once you pay that interest in that year, it is an expenses.
Within the next year.
Wait, hold on. If you pay it within that year, it is an expenses. And it will be treated in the statement of financial performance.
Yes.
All right?
Yes.
But it is because you did not pay it within that year till the end of the year. That is why it is now treated as a liability. And it has to be treated as a current liability. Even if you don't pay it in the next 3 years, it is still a current liability that you are supposed to pay within 1 year, but you have not paid it. So it will still be treated. If you buy goods from your supplier, is it a current liability or a non-current?
Goods from the supplier.
Yes. If you buy goods from a supplier on credit,
goods, that's a current now.
It's a current liability. But even if you don't pay back your supplier in 3 years' time, till that 3 years, you will still be carrying that debt as a current liability. You will not say because it has been 3 years that I have owed them, I will now put it under other non-current liability. No.
Okay.
It is the nature of that item itself makes it a current liability.
The nature of that item. Okay.
The nature of it makes it current liability because it is an interest that has to be paid within 1 year. It's a current liability.
Okay. Thank you very much, sir.
So, if you don't have any more questions, our time is fast spent. Okay. This person is asking for million and billion. No. Please, I don't understand the calculation of non-current assets or how we get total accumulated depreciation. Please, you have to watch that video. Maybe you have to rewatch the video with the question, and I believe you get it. The person that is asking for the figures, how we change the billions, the millions to billions. Okay, if you look at it, they are mentioning billions in the question, and here you are typing in thousands. and then we put our millions up. So if you put this million in front of the figures, of the 1,000 figures that we have here, you have your billions. That's just the way it is. So we have this figure is supposed to be like this. It's supposed to be 287,500. Then with million, which is 6 zeros, 1, 2, 3, 4, 5, 6. So it's supposed to be like this. But we have said, okay, we are putting million up. So we have that we took 6 zeros and put it up to represent million. And that's the way I can explain that one. So I think we can wrap up this class for tonight. Thank you very much for staying till this time. It's already very late. So next week, God willing, we'll continue from here. Let me call Mr. Tutor.
Yes, sorry, sir. Will this solution be sent to the group chat, the Excel file?
Yes, it will be sent to the group.
Okay, thank you.
Okay. Good night, everyone.